In this video, we'll learn about what is ELSS mutual funds, what are tax-saving mutual funds, and common mistakes while buying ELSS funds. Most experts agree that among the several tax-saving options, equity-linked saving schemes, that is ELSS, offer an excellent combination of shorter lock-ins, market-linked returns, and greater flexibility, making it one of the top choices for investors. An ELSS fund can help you save as much as Rs 46,800 in taxes per annum if you are in the 30% income tax bracket, and invest Rs 1.5 lakh per annum qualify. An ELSS is like any other mutual fund scheme that invests primarily in the stock market. The only difference is that an ELSS comes with a 3-year lock-in, which means you cannot sell your investment before 3 years from the date of purchase. In case of an ELSS SIP, each installment is locked in for a period of 3 years, which also means each installment will have a different maturity date. Investments in ELSS up to a maximum of Rs 1.5 lakh per annum qualify for income deductions under Section 80C of the Income Tax Act. What this means is that you can deduct the amount you invest in an ELSS from the total income to reduce your taxable income and therefore your taxes. Let's take an example to better illustrate this. Mahesh is a senior software engineer with a taxable income of Rs 12 lakh a year. This puts him in the 30% tax bracket. He decides to invest Rs 1.5 lakh in an ELSS fund. Under 80C of the Income Tax Act, this brings down his taxable income to Rs 10.5 lakh and translates into a saving of Rs 46,800. That is 31.2% of Rs 1.5 lakhs. So why should you even consider ELSS? Investment in other tax-saving instruments under 80C, be it in tax-saving fixed deposit or employee provident fund or public provident fund or national saving certificates or ELSS, qualify for the same income deductions. But ELSS holds an edge on many counts. Firstly, it's the shortest lock-in. ELSS has the shortest lock-in of all 80C investments. Of just 3 years, tax-saving FDs have a 5-year lock-in and PPF have a 15-year maturity. Thus, ELSS allows you greater flexibility in the medium term, potentially higher returns. Most of the 80C investments after returns in single digits on an average, anywhere between 6 to 8%. ELSS has the potential to offer significantly high returns since it invests in a portfolio of equity instruments. Better post-tax returns. Except PPF and NPS, ELSS offers better post-tax returns other than 80C investments because long-term capital gains of up to 1 lakh a year from ELSS mutual fund are exempt from income tax and long-term capital gains above 1 lakh are taxed at 10%. Ease of investment. Investing in an ELSS is simple. You can put your money via a systematic investment plan, that is SIP, or a lump sum. You can continue holding your ELSS units after the 3-year lock-in, but if you choose to sell them, you can do it online in just a few clicks. The funds are credited into your account within 3 to 4 working days. Before you think about parking your money in an ELSS mutual fund, here are 5 common mistakes you should avoid. Firstly, don't exit immediately after 3 years. One of the most lucrative reasons why people invest in an ELSS mutual funds is to save tax. In order to save tax, you have to keep your investment locked in for 3 years. Yes, an ELSS mutual fund comes with a mandatory lock-in period of 3 years. Other financial instruments such as FDs, PPF, and long-term deposits have a lock-in period of 5 years or more. Investors usually tend to book profits once the fund has completed its 3-year tax break and make on exit. If the mutual fund is performing well, there is no need for you to walk out. It's best to stay invested. In fact, stay invested for as long as you want. Staying invested for a longer duration will only increase your returns. Another plus point is that an ELSS mutual fund is managed by professional fund managers. You do not have to look after investment on a day-to-day basis. Section 80C limit. Investors often look at ELSS mutual fund as the last resort of saving tax before the financial years. Investing in an ELSS mutual fund for the purpose of tax benefits is not sufficient. Sooner or later, your Section 80C limit will get exhausted and seem inadequate. This is applicable as your income increases. You should look at the long-term benefits of an ELSS mutual fund investment. Over the long term, more and more money will get invested and will ultimately lead to high returns. Therefore, you should look beyond the limits of Section 80C. Systematic investment plan. Investment in an ELSS mutual fund should be done via SIP. This has its many benefits. First, your SIP will correlate with your monthly outflows and inflows. Second, you'll gain from the benefit of rupee cost averaging in times of market volatility. Third, the lock-in period of an ELSS starts from the date of investment. This means that the lock-in period will begin exactly from the month of investment for each SIP. This gives an investor a 1-year advantage in making their ELSS funds more liquid. Multiple ELSS funds. Many investors have the habit of selecting ELSS mutual funds issued by different banks or asset management companies. Over the investment years, they end up taking multiple ELSS mutual funds from 7 to 8 AMCs. This is not an ideal situation as every ELSS fund requires some time and effort. You need to track the performance, check the indexes, be aware of the competition, control the expense ratio, and revise the portfolio if needed. The more ELSS mutual funds you have, the more time and effort will be required to check the performance. Therefore, it is ideal to track close to 1 to 2 ELSS mutual funds instead of holding 7 to 8 ELSS mutual funds. The last thing that I want to talk about is risk appetite. The very purpose of an investment begins with the two things: your risk appetite and the financial plan. The sense of perspective will determine how much investment is required in an ELSS mutual fund. This is heavily dependent on your risk appetite. Investing in an ELSS mutual fund should be a part of your overall financial plan or goal. This will further help you understand your purpose of investment. You'll definitely end up saving tax with an ELSS mutual fund, but it can backfire if it does not fit in your overall financial plan. Recently, ELSS mutual funds have become a popular choice among investors for the purpose of tax saving. As mentioned before, over the years, ELSS mutual funds have performed pretty well in the market. They have an excellent track record with respect to high returns. The popularity of ELSS mutual funds is the reason why it has surpassed PPFs, FDs, and SBDs to become a preferred investment choice. You can visit our website stockquantum.com for more information, and thank you so much for watching.